What's up, Dope Chasers? This is Jason White, CEO and founder of Witness Riches, the 700 Club. We help people improve their finances and boost their credit scores. Today, I'm going to be talking to you about buying a car with bad credit and how stupid it is. All right. So a lot of people are in a predicament where they have bad credit, but they need transportation. I understand that completely. Sometimes when you are in this predicament, you have to do what you have to do in order to do what you have to do, if that makes any sense to you. All right. So the thing is, we want to, transition out of that particular situation so that we can actually transcend to another level. And in order to do that, we have to use information to our advantage. And basically what I want to try to educate you on is how you can turn this stupid situation into an educated situation for yourself so that you can begin to make better financial decisions instead of losing your money to interest payments. All right. So let me see here. Let me know who you are, where you're from. Seems like we may be having some network interruptions. Let me try to get this right. In the meantime, while I'm working on this, let me know who you are, where you're from. Also, like and share this video because there's going to be a lot of people who can actually relate to this particular situation who need this information. So if you're new to the channel, let me know who you are, where you're from. Like and share this video on your news feed, on your timeline, and make sure that you engage with me so that we make better decisions. All right. So what I'm going to be talking about are contributing factors that influence your ability to get a car loan and also your interest rate. Okay. One of those first factors is, of course, your credit score. Typically, in our credit repair program, I recommend that clients do not look into buying a new car until their credit score is about a 680. Because at that point, you can at least get a 10% or lower interest rate on your car note. Now, of course, there's more contributing factors to getting a car loan, but you want to at least have a 680. But what happens is when people are buying a car, their credit scores are typically under 600. And when you have bad credit and you're trying to buy a car note, what they're going to do is they're going to transition you to what is called subprime lenders. These are actually companies who make tons of money off of people who have bad credit. And what happens is they'll pull your credit. They'll shop around your information to maybe 15, 20 banks. Now, of course, that's going to hurt your credit more because 15 to 20 banks means 15 to 20 inquiries added to your credit report. But that's another story. We'll talk about that at another point. But anyway, they'll shop your information around, and basically, dealerships, they make a commission off of the companies that they send you to. So depending on how honest your dealer is, they may try to get you the best rate, but depending on how tight their pockets are, they're going to, put you with that subprime lender who's going to take advantage of you. Anyway, really quick, what I want to share is how a bad credit loan, how significant the interest can be when it is connected to your credit score. Okay, so the example that we're going to use is a $20,000 loan. You can get you a real nice vehicle for $20,000. Okay, let's say you get a $20,000 vehicle, and the bad credit, you're going to have maybe a 22% interest rate. And typically, they'll set you up for a 4 to 5 years repayment plan. Let's go with 5 years, aka 60 months. Okay, so what this is going to do is this is going to put you at a monthly payment of about $552. So that's basically how much you're paying a month for this mortgage. And what we want to do is we want to see how much interest we're going to be paying if we get a $20,000 loan. So we multiply that by 60. Basically, what you'll end up paying for this car note is roughly $33,000. Okay, so that's what bad credit will end up costing you, $33,000 for a $20,000 loan. Okay, now a lot of times what happens is people will be in a situation where they'll see this car note and they'll say, you know what, I can afford $552, right? And if you're in that situation, I always say, just because you can afford it does not mean it's a good deal, all right? So keep that in mind. So $552 for 60 months will end up costing you $33,000 when it's all said and done. Good credit, for the same loan, $20,000, good credit, above 700 credit score, you'll probably get about a 3% interest rate. Over 5 years, that's going to get you roughly about a $359 payment. Okay? And what we want to do is we want to see how much that's going to cost you altogether. So over 60 months, you're looking at about $21,500. Okay? So the difference is bad credit is going to cost us $33,000. Okay? Good credit is only going to cost us $21,000. That there is an $11,500 difference. The significance is with the good credit, we're only paying $1,500 in interest. Right? With bad credit, we're paying $13,000 in interest because of your credit score. So that means that you're almost paying 2 car notes for 1 car just because of your credit score. So what we want to do is we want to, make better decisions so that we don't, take extra money out of our pockets. Because typically, if you're paying 2 car notes for 1 car, you need that money, right? So what we want to do is we want to, of course, work on our credit so that we're not in the bad credit situation, all right? So the credit score is definitely the biggest contributing factor to someone getting a bad credit loan. The other contributing factor is your debt to income. We have, many of clients who actually have, good credit, but because their debt to income is so high, these lenders, of course, they want you to be able to have good credit so you get a good interest rate. But if your debt to income is higher than 40%, you look dependent on debt, right? And they don't trust you too much. They're going to give you the car, but you're going to end up being in the subprime category. So debt to income will definitely hurt you if your debt to income ratio is above 40%. And really quick, what I want to do is just show you how to calculate that. What you do is you calculate all of your debt payments that you have. So you look at your credit cards, you look at your student loans. Let me fix this really quick. You look at your mortgage if you have one. If you don't have a mortgage, they're going to look at your rent payment. All right, so your rent. And any other monthly obligations that you may have, okay? So there's an echo. How is the connection? Do we have a good connection or do we have a bad connection? Let me know, because I would hate to go throughout this whole presentation and it sucks. It's good? Okay. So they're going to look at your credit cards, your student loans, your mortgage if you have one. If you don't have one, they're going to look at your rent. And they're going to look at your other monthly obligations. So if you have other lines of credits out there, they're going to look at that. And what they want to see is your monthly payments for all of those debts. So let's say that you have, credit cards, $50 a month, student loans, $150 a month, mortgage or rent. Let's say that is $1,000 a month. And then you have another line of credit where that is $200 a month. Okay, so what we want to do is we want to add those monthly amounts together. So we have $200, $1,500, $1,200, $1,400 a month. Okay, so $1,400 a month in debt payments. Okay, and what we want to do is we want to compare that to our income. Let's say that your income is $2,500 a month. Can someone do that calculation for me? 1,400 divided by 25?
What?
$1,400 divided by $2,500. What that is going to equate to is
1,400 divided by what?
2,500. 1 second.
That's 0.56.
Okay, so that's a 56% debt to income. If this is your situation, that means your debt to income is 56%. They want it to be under 40%, right? So if you have high debt to income percentage, what's going to happen is they're going to place you in that subprime lending category. And even though your credit score is good, you're paying your bills on time, you don't have any derogatory information on your credit report, but due to the fact that you have a high debt to income ratio, they're going to put you in the subprime category because, you know, they sort of trust you. You're going to get a bad interest rate, 22%. So what you want to do is you want to work on lowering your debt to income. And how you do that is you pay off particular debts that impact that. And what I would recommend, of course, is in this situation, maybe getting rid of the line of credit and paying off your credit cards. That will eliminate $250 a month towards your debt to income, and that will put you at $1,150. So what's $1,150 divided by $2,500? Almost got it.
4.96. Or no, 0.46.
Okay, so that's at, I'm running out of space. That's at 46%. Okay, so due to the fact that you're unable to get that under 46%, another way to lower that debt to income ratio, you've done your best at lowering your debt, but another way to lower that percentage is to increase your income. So what if you started a side gig where you were making $250 to $500 a month? What if you were able to increase your income to $3,000 bucks? What will that result in your debt to income? $1,150 divided by 3,000. What would that do for you?
That is 38%.
That'll put you at 38%. By doing that, being strategic and focusing on areas that will improve that will take you out of the subprime market and actually allow you to take advantage of your good credit score. Okay? So that's information that some of you probably didn't know, right? So basically what you want to do is you want to look at the factors that impact your ability to get a good interest rate that hurt you, and you want to begin to develop a plan against that so that you don't have to go into the subprime market, okay? And then the last thing that's going to hurt your ability to get a good interest rate and force you to buy a car with bad credit is your work history, okay? They want to see stability. If you have a job where you've been there under 6 months, this could put you in the subprime market because they don't know what this may turn out to be. They don't know if you're going to be here, the next year or two. They want to make sure that they get their money. And because it's a high risk when working with you, they may put you in the subprime market, okay? So if you are someone who is, being taken advantage of because of your bad credit, what you want to do is you want to begin to work on these components. Maybe you need to work on improving your credit score. Maybe you need to work on lowering your debt to income ratio. Or maybe you need to just stick it out with the job that you have a little longer so that you don't have to fall into the subprime market. Maybe you have to make that sacrifice. However, if you're not willing to make that sacrifice, what you want, which is a good interest rate, what you want will be the sacrifice, okay? So you have to figure out what's more important to you. Paying $13,000 extra or saving $11,500 on interest payments because you made the proper sacrifice, okay? So hopefully this information is helpful. Just trying to help you. One thing that I want you to keep in mind is if you have a bad credit loan where your interest rate is above 10%, okay, I would highly recommend in the first 3 years you focus on improving these 3 components. That way you can save money on your interest payments, okay? But keep in mind that if you refinance, it's best to do it in the first 3 years. And something that will cause you not to be able to get a refinance loan is if you have what I call 6 within 6. And if you have more than 6 inquiries that have occurred in the last 6 months, this could cause you to get denied for a refinance loan because you look desperate, okay? In my opinion, 6 inquiries, that's really nothing because you can get that in 2 days. But to the creditor, you look desperate, okay? And we have, seen many of times where a client has great credit, low debt to income, but they have more than 6 inquiries within the last 6 months, and they get denied for refinancing their loan, and they have to stick it out, okay? So one thing that you can work on is, improving your credit. As you know, we do offer a credit repair service. So if you are someone who is looking to get out of this subprime market and looking to save money on your car note, look into our credit repair service and we can assist you. You can learn more at www.the700clubcreditrepair.com, or you can give us a call. Our office is open until 9 p.m. Eastern Standard Time today. Our number is 419-824-0004. Anyway, my name is Jason White. Hopefully this information is helpful. Do me a favor. Can I get a like? Can I get a heart? Can somebody share this? Help your boy out. Let me know that you are appreciating this information. Like this video, share it with your friends, and make sure you subscribe to our channel. Thank you for your time. I'm out. Peace.